All right, let's go across to the Axis Bank management, who is addressing the media at this point in time.
Years, but it's still not very large. So the opportunity and the desire on our part to grow this business remains very strong. Our focus on the retail customer has also led to sustained growth in our granular deposit franchise through our CASA plus RTD strategy. The bank had strong deposit growth during the quarter at 22%. Despite this strong deposit growth, CASA is another area we need to do better. We need to improve our CASA growth going forward, and our teams are working hard towards that goal. During the quarter, we opened 190 branches, our highest in the last 24 quarters, to take the bank's overall domestic branch network to 4,284 branches. Branch banking continues to be an integral part of our growth strategy. Despite these investments in extending physical branch network, we have been able to keep OPEX growth under control at 6% year-on-year. In the small business and MSME segment, there are some signs of stress in terms of delayed payments. We need to remain cautious as the funding issues in NBFCs could have a bearing on this segment too. The bank's risk performance in this segment remains steady, but we are watching things closely for any adverse development. Given some of these conditions, the bank is also being cautious about the growth opportunity in the SME segment right now. Our subsidiaries continue to deliver strong operational performance in a very challenging environment that for NBFCs, Axis Finance continues to thrive and has delivered strong returns with stable asset quality. Axis AMC has been gaining strong incremental market share with several of its funds among the top performing ones in their respective categories. Axis Capital continues to be a leader in equity capital markets, having executed some of the market transactions during the quarter. During the quarter, the bank also raised 12,500 crores of capital through a QIP issue. We understand that this was the largest ever QIP by a private sector issuer. Successful closure of capital raising in a current tough market conditions is a strong indicator of investors' willingness to partner with Axis Bank in the bank's long-term growth journey. Axis Bank is now in a position of great strength with capital and most of the senior management team's addition in place. With most of the asset quality issues behind us and strong competitive position in the current environment, we remain committed to delivering on our GPS strategy. We continue to invest in our conservative stance on provisioning, compliance and risk. We have a lot more to do on improving and automating our systems, controls and processes. It's a gradual process. It will take time, but we are working at it and improving every day. With that, let me hand over to Jairam to take you through the bank's financial performance in detail.
Thank you, Amitabh. As you said, I'll also try and keep it brief. A quick rundown on some of the numbers. Profit before taxes for the bank for the quarter stood at 2,433 crores, up 109% year-on-year. There was a one-time tax impact of 2,138 crores due to change in corporate tax regime. X of this extraordinary item, profit after taxes would have been 2,026 crores, but including this, it was a net loss of 112 crores for the quarter. Operating profits for the quarter were up 45% year-on-year. Net interest margin was at 3.51%, the highest in the last 9 quarters. Our cost to assets ratio continues to improve at 2.06%. It was the lowest it has been in the last 12 quarters. Provision coverage ratio continued to increase for the 6th consecutive quarter and is now at 79%. We also hold 2,600 crores of additional provisions over and beyond what we count in our PCR calculations. Gross NPA and net NPA ratios also fell for the 6th consecutive quarter. We are now at a net NPA ratio of 1.99%. In terms of slippages, of all the corporate slippages that we saw, 97% came from previously disclosed BB and below rated clients through their loan and investment exposures. Overall BB and below funded exposures reduced from 7,467 crores last quarter to 6,291 crores, so a decline of 16% quarter on quarter. Loan book grew by 24,000 crores in the quarter, our highest growth in the last 8 quarters in absolute terms. Deposits grew by 23% year on year in an environment in which market deposits are growing by less than 10% year on year. So the bank has done really well on overall deposits. As Amitabh said, we have added 190 branches, the highest we have added in the last 24 quarters. And finally, with the capital raise that the bank did recently, the bank's common equity tier 1 ratio was at the end of the quarter 14.04%, the highest ever common equity tier 1 for Axis Bank. So those were some of the metrics. You've seen some of the data and information in detail. We're open to your questions now.
Any particular reason for the extra provisions in this quarter?
No, we continue to be conservative in terms of provisioning on NPAs as well as the stress pool, whether it is the BB pool or the SMA pool, etc. So we decided early this year to start providing for them on a formulaic basis consistently. That's what we continue to do. There is nothing special going on.
But is there any trigger in terms of more stress in the SME or the retail book?
No.
So, just a question. Your total slippages was 4,983 crores, of which 2,862 came from corporate. So, if I assume 2,100 come from the retail and SME book, you just said that you're cautious about the SME lending. Is this due to larger macroeconomic challenges, or what are you seeing in your SME book, or at least?
So let Jairam talk about the specific numbers, and then I'll be.
Yeah, I think if you look at the overall split, 2,800 crores of gross slippages from wholesale, 1,300 from retail, and about 760 odd from SME on a gross basis. But on a net basis, if you see IE X of all the recoveries that we got very strong recoveries in retail during the quarter. So net additions in retail or to NPA were only 500 crores and 450 odd crores in SME. These numbers are not large in absolute terms. We are okay with it. That said, it is true that given some of the stress that is going on in the larger corporates, where some of them are not getting payments on time, they in turn are not paying some of their SMEs on time, and that's creating a little bit of stress in the system. So overall, we have gotten a little bit cautious as cash flows are getting a bit stressed and stretched, I should say, not stressed. So we are looking at where the market goes before we get a little bit more aggressive. You see that in our growth rate numbers as well, where we have slowed down growth in commercial.
But you don't need to add any.
Just let me just add, if you don't mind. If you look at our overall stock of stress assets, you will see that overall, firstly, our stock has come down. Secondly, you also have to recognize, and we said that last time also, that some of the assets in our stock of BB and below has been there for a long period of time. And in a deteriorating economic environment, we have seen some of this stock kind of go into slippages. So we have said that yes, some of our slippages will continue to remain at elevated level if the economic conditions do not improve. We obviously continue to, it's not that whatever goes into slippage is not recovered, we do recover. Adding on the SME side, yes, as Jairam very rightly pointed out, that we have to be cautious given what we are seeing. The payments are getting delayed, some of the sectors are impacted in a big way, and I think the sector which gets squeezed the first is MSME in the SME sector, so we have to be cautious around that. As far as our retail book is concerned, we are not seeing any signs of any stress in any kind of portfolio of ours at this point in time. But we have been saying it again and again repeatedly that we have to remain cautious, we have to watch the book, we have to ensure that we take corrective actions as and when we see any signs of deterioration. But right now, nothing is yet. Sorry.
I was saying merely that because you flagged off these risks in SME, obviously the NBFCs, etc., would you not look to add these to your BB and below rated book to sort of guide the investors accurately about the kind of stress that you see?
Yes.
Or do you think this is something that may not be used?
See, the SME book, the total SME book that we have is close to 60,000 crores. The split of that by rating we offer every quarter to the investor community, and you will see that about 10% of that, or just under, has been under below what we call SME 5. That is the indication that we have always been offering in terms of what's going on in the SME segment. The BB portfolio we've kept for large corporates, and we think that's where ratings make a lot more sense, and they are a lot more stable and predictable. And you will continue to see us offer that as the core area of guidance in terms of where stress is coming from. As I mentioned before, of the 2,700 crores of net NPA formation that we saw in this quarter, only 450 came from SME. So it's small enough that I don't want to nuance it too much in terms of trying to predict that too precisely.
All right, that was the